Hello traders, it's Wednesday, April the 24th. This is John Kickletter, Chief Strategist for DailyFX.com, here to give you your FX market wrap-up and outlook for the coming 24 hours of trading. Fundamentals are taking up a little bit more of our trading day. We are seeing headlines that are becoming a little bit more proactive and giving us a lot more volatility from the markets, though it's not in those themes, those underlying themes that we really look for, namely risk appetite trends, which if it can take over, will spell the consistent trend we have long been waiting for, whether it be risk on, risk off. I think it has more potential towards risk off, but we won't be picky. If we do have that consistent common theme, it presents trading opportunities which we can take either way. But looking at those individual catalysts that we are using as we go along, I think one of the more remarkable headlines we had this past session came from the euro. So we'll take a look here first today. Now the euro dollar reflects a lot of that volatility we were talking about, but it was a consistency across most of the euro-based pairs. We had the euro pound, which was on the move, as well as the euro yen, the euro CAD, and also the Euro Kiwi and Euro Aussie, but I don't have those up. We'll concentrate our conversation to the euro dollar. This was actually one that I was up late night for my time frame, and I was actually watching the release of the German PMI data that we had cross the wires early in the European session yesterday, and the outcome was substantially disappointing enough that it would lead to a significant drop on the euro dollar. We finally took out that 130 level. Now that's a level I've been looking at quite intently because it had the potential of showing progress on this head and shoulders pattern. Well, we broke that level, and tentatively I did take a short position. I held it for only 30 minutes, however, because I knew that we were coming up into some more significant event risk in the Eurozone PMI figures. Those ended up being in line with expectations, and it leveled off a little bit. And the concern that came to the euro with that event risk was not the kind of drive that would convince me that the euro dollar would drop. Now, if that data did come out as it did, and we also had stable or negative rate or risk trend, then I would say that yes, a continuation was much more possible. Now, if risk aversion had kicked in and we did have a drop from equities, whether they be the S&P 500, the US-based equities that we see here, or we were looking at European equities, it really wouldn't matter because it would be risk aversion that was carrying the euro dollar, not just the negative data. But that being the case, we did see that there was a positive risk trend, which would in fact further work against the continuation here because the euro is a fundamentally risky currency as the US dollar is a safe haven currency. And we have to once again refer to our measures of risk between the euro dollar, and we can see here the EU-US credit default swap comparison. You can see that is a nice fundamental comparison, yet that is still rising, so that is something that tempers my interest there, as well as the Spanish 2-year government bond yields, which have hit multi-year high or multi-year lows, and the Slovenian 9-year government bond yield, which has dropped as well. These are flipped upside down because as the yields drop, it's bullish or positive for the euro because it removes some of the financial crises there. So that being the case, the fundamentals were notable, and the conversation, particularly from this round of event risk, I was most interested in the German PMI, it seems, as most of the market was, because in that data, there is speculation that the ECB could once again start to contemplate the possibility of interest rate cuts. Now, why would Germany's PMI data be such an encouragement where we've seen steep recessions in many of the Eurozone economies? We've seen inflation figures back off to well below the 2% target, and we've also seen financial stability questions come up. Why is Germany so important? Well, the issue is not necessarily with Germany, technically speaking, it's with the entire Eurozone. But Germany represents the largest and most growth-intensive country in the world, in the region, and subsequently their inflation also ends up being the most important as well. All right, whether that should be the case or not doesn't matter. Their country ends up having a greater influence over those bearings. So the market looks at these indicators, and when it sees that the manufacturing sector for Germany, which is a major component of their growth, drops back from the expected 49 reading to 47.9. Anything below 50, by the way, is contractionary. When it drops back to 47.9, it suggests that the growth path for the region's largest economy is negative, and subsequently that is a risk to the region, the core of the Eurozone. So add that to the recessions of the periphery, so countries like Greece and Spain and Portugal and Ireland, as well as the financial troubles that those regions have, and the markets think that there is probably going to be something done by the ECB to offset the austerity pressures that the governments are putting into place. And that is either one of two things in this scenario, in this world, and that is an open-ended stimulus program, which it's not actually easy for the ECB to pursue something like that because they do have something already in place. It's just not activated and wouldn't be activated by those circumstances. It's much more likely to be something like a rate cut, but a rate cut, fundamentally speaking, medium to long term, not going to do much for the region, but one thing it would do is further lower the yield on the euro. If you look at the correlation here between the US and Euro LIBOR 1 month rates, you can see the correlation is relatively decent. But over the longer period of time, that yield is almost non-existent. In fact, it's negative. So you would even further diminish the return appeal of going long euro dollar. So that was the event risk that was most pertinent and most volatility inducing for the world's most liquid currency pair this past session. Going forward, the euro is certainly going to remain in our view. Also interesting on the docket was the fact that the Bank of Spain released its own GDP assessment of the first quarter, already showing a significant contraction through the quarter, and we have the official GDP stats figures next week, but that's already setting up a very poor tone. We had also a number of issues from Cyprus and Greece and votes that we have going on there for more rescue funds and whether they'll be released or not, but really the focus seems to be on the ECB. That's a passing issue unless there's something that specifically says in the coming days whether they're actually considering pursuing that appeal. Nevertheless, watch the German IFO that you have coming up, as well as ECB member Mersch's comments. He could speak potentially on monetary policy as well. Aside from that, the Eurozone is not very dense for event risk. It's going to rely on other currency pairs. Now, the U.S. dollar on this side of things certainly brings back into picture, back into focus, the risk elements of this market and even the risk elements for this particular pair. So our focus going forward should still be on risk-based trends. That being said, you see here a nice 3-day rally for risk trends through the S&P 500. But when we look at the measurement of risk appetite against the fundamentals of risk reward, the level of return for the markets versus the level of volatility of the markets, you can see that we're still deviating quite substantially. It's leveled off the risk reward index, but that is not the bullish implications that the S&P 500 brings to us. Longer term, we know that this deviation is quite substantial. Where's the fill-in for this? It is not just the Fed, but the Fed does give a good benchmark for the lead-in to the filler. The stimulus expectations. The Fed and other central banks around the world are buffeting and filling in for any risks that are seen in the future, and thereby encourage risk-taking while pursuing extremely low-yielding investments. All right, so we can see that right here in this comparison between the S&P 500 and the return or reward aspect of my risk-reward index. So risk trends, as we say, are certainly the biggest driver, but as you can see here between the 4 market classes that really reflect risk trends against very different markets. You have the dollar yen as a carry trade reflection, the S&P 500 as equities. You have the 10-year government bond yield, all right, as the opposite of safe haven appeal, and the commodity index. 3 of these were up, 1 was down, but they were all in very restrained fashion. If they all move at the same direction at the same time with a great level of volatility, that's when we start to talk about big market movement, and that's when we talk about a market derived from risk trends. So even though we had the S&P 500 marching higher, it didn't really carry the level of influence that would say strong risk appetite trends for all the markets. So that's why we didn't get a big jump up in the euro dollar, not to mention also the interest rate expectations that we had there, nor did we get a big jump up in the Aussie dollar or the yen crosses, though they were, the dollar yen was edging higher just as the euro yen recovered a lot of lost ground and the pound yen recovered lost ground, and you had a tentative positive for the more yield intensive yen based carry trades, the Aussie yen, the Kiwi yen, the CAD yen. Now, remember, the interest I have in the dollar yen is more magnetism. It's like an animal magnetism. The market is really, really encouraged to trend towards that 100 level. Not necessarily because we're talking about risk appetite trends, which does bolster the appeal of the carry trade. All right, and the dollar yen doesn't have a lot of carry trade behind it, but all the selling of the yen against all its other counterparts looking for carry spills over to the dollar yen. But the interest is more in the terms of the Bank of Japan is heartily trying to push the currency down. We have the primary trend is already very, very consistent, and that's a consistency that will certainly carry forward. And we also have the aspect of, hey, I know that there is a big level here and that the market is watching that level very closely and that a lot of people are looking to trade that level. So if we had to break above 100, what's the likelihood that you're going to have a significant round of entry orders above as well as stop orders on short interests, short trades above? Very high. So it's the same situation that we had when gold was coming down towards the 15.25 to 15 even level. Once we crossed that threshold, triggered a ton of orders, stops, and entries, and it just drove it further down. The same could potentially happen with the dollar yen. Just don't expect the level of intensity that gold had. It took years for that gold level of intensity to build up. Now, an interesting aspect of dollar yen, I want to point out because we saw this. We had a very unique circumstance, a very unique instance to see in the market who's playing the role of risk trend. Here we have the S&P 500 and S&P 500 E-mini futures. All right, so that's just futures market volume interest. All right, and you can see here that this is an intraday chart. You can see this huge spike in volume. The catalyst there was a errant tweet released on the AP handle. All right, a very renowned news organization, and that tweet was that Twitter handle was apparently hacked, and we found, and the tweet itself said that there was two explosions that went off in the White House, and that the U.S. president, was injured. Of course, this was later proven to be false, and they were hacked and told to disregard. But the impact on the market was quite severe. You had this big increase in activity for the S&P 500 markets. You also had, this zooms in a little bit so you can see the price action itself, a huge drop in the S&P 500, dropped down approximately 14 handles or 14 points and completely reversed. This 14 point drop happened in the span of as little as 3 minutes. All right, so that was the equity index. This was a very clear impact on risk trends. All right, that being said, let's see who had that impact. Here is the FX world and the reflections that we see in risk trends. This was the time frame for that release. Dollar yen dropped 75 pips, but what happens to euro dollar? Unmoved. All right, that is a good sense of who is going to react to risk-based trends should those conditions really start to pick up. Now, the dollar yen is going to be much more sensitive. So if you do have this drop-off in, of course, I like U.S. equity indexes for my easy benchmark, but it's really if we see risk trends play out on all these different asset classes, because the broader and the broader we see that influence, the more dramatic the impact. But risk aversion will have a greater impact on the dollar yen and all the yen crosses, but it will also potentially have a euro dollar impact as well. It will just be not as sensitive as the dollar yen and the yen crosses. So something to keep in mind. That is a particularly interesting situation that we have there. And in the coming the rest of the week, the second half of this week, we do have some event risk that can tap into risk-based trends or individual performances of these major currencies. But as you can see in the upcoming session, nothing in the way of very severe action. It really doesn't until Thursday and Friday when we start to really talk about the things that can tap into serious trend development for the major currencies or risk-based trends. UK GDP, Bank of Japan rate decision, and the US GDP forecast, or the GDP reading for the first quarter. Those are the big ticket items. All right. So in the meantime, we need to keep an eye on the headlines and the news wires because they'll tell us if anything unbecoming starts to cross the wires. But without those catalysts, we'll have to look for more higher probability setups. Now, I like the euro dollar, but to really get a breakdown that it really encourages my confidence that it has follow through. I need either a really troubled euro forecast, the one that can hit trader's pocketbook, or a risk aversion move. Now, if we do have risk aversion move, we are rich with options. All right, we have plenty of trade setups in a true risk aversion world. Kiwi dollar, Aussie yen, Kiwi yen, CAD yen. The options are endless, but that's unlikely to occur if you don't have a clear catalyst. In the meantime, if risk trends are stable, I'm going to be watching that dollar yen as it trader approaches and looks at that 100 level with ambition. All right, so I'm going to look for a break above here. I do think it has quick follow-through potential. Of course, risk aversion is always going to be a threat to the dollar yen if it tries to break 100, but in the absence of a committed risk aversion move, it can just allow the 100 magnetism to simply pull the market forward and even drive it a little bit beyond that as we clear orders. So that's an interesting setup that I'm sticking with, that I will keep as my scenario. Alternatively, I'm also watching a pound dollar base move. As you can see here, we have a descending channel within a rising channel. All right, there's other technical levels surrounding this, but in the end, you can actually see that there is a breakout opportunity here regardless. It either has to go up or down, but it has to break. So I will keep an eye here for the short-term implications. A break to the downside would do better in risk aversion world, but it still has potential on the shorter time scale. A break to the upside can carry through a little bit further, maybe up to 154 is where we start to have to question its momentum. But at that scale, then we can also see if it has follow through, and you can take maybe partial profits on that and then move further. So that's an opportunity I like as well. In general, I like the pound across the board. Here we have this is turning in from a channel to a head and shoulders pattern with the potential of a break below 85. I'm keeping a very close eye on that pair, which I like a lot. But as I've said a number of times in the past, I really like the pound Kiwi as it's an inverse head and shoulders with the head at a record low level. The Kiwi this past session was a very active currency. We did have a pickup or a rally from the Kiwi on the day. Here's the Kiwi Swiss, and we also had the Kiwi dollar which bounced. What was the catalyst? Well, the RBNZ rate decision, in which they held rates and they said that the growth may improve a little bit, but besides that, they were very concerned about the level of the currency. They also said that they expect to hold rates at the standstill until the end of the year. All right, there was little to no speculation that they actually cut rates. So this was very, very little encouraging or bullish interest here. It seems that this was just a relief move. So I'm not encouraged by the bearish moves on pairs like Kiwi dollar or the bearish move on pound Kiwi. And I'm certainly not. I didn't participate in this breakdown of the Aussie Kiwi. We knew this was going to go for a break of some magnitude, and it did break to the downside. But I didn't like it to the downside because the fundamentals didn't say it was actually bullish Kiwi or a bearish driver for the Aussie Kiwi. So interesting setup there. Where fundamentals have baited a lot of people in, it ends up being a non-mover with actual volatility implications. So I still like this pound Kiwi, potentially to the upside here. The best possible catalyst for this particular mover, one, we have Thursday, the UK GDP reading, but we also have the potential for the risk aversion move. And risk aversion, yes, the pound is exposed to risk going forward, but it's the Kiwi that is the investment currency and will take the heavier impact. So we'll keep a close eye on that. In the meantime, keep a close eye on gold as it continues to try to retrace the massive losses it had through that the Friday of the week before and the Monday of last week, but it still hasn't retraced 50% of its initial losses. This is an interesting setup and shows that in this contraction or in this retracement, we really do not have a shift in trend, and we may not get that bull run back up to 1800 unless we have some very significant encouragement. Meanwhile, we also have other markets that are keeping in interest, which is here we have U.S. oil, which is facing down 1990 as a former support as new resistance. Now, risk trends spill over here as well. I'm watching the U.S. dollar, and this is one of my top interests as of right now because this has closed with Tuesday's close at a 2.5-year high. All right, interesting because we also have the U.S. equity markets driving forward as well, just off of record highs. It's an interesting combination, and it shows that those correlations that we usually fall back on and can generate with the best probability meaningful trends, risk appetite, all right, is still deviating enough that we have the top safe haven and the top risk measure both going in the same direction. Two multi-year highs, if not record highs. So a very interesting market condition. It's a reflection that we do not have the fundamental necessities for consistency in driving new trends. Keep that in mind, but look for the shorter term. We still have good opportunities out there, whether it be based on scheduled event risk or thematic interests. You just have to wait and see when you have those technical breakouts matching up with the fundamentals to give the follow-through. Good luck trading out there, guys, and I'll update you once again on the markets tomorrow.